Good morning, John. It's good to see you. We're recording this on Thursday morning. John, the news of the week, I guess, would be that the US labor numbers came out stronger than expected, which basically put the sword to the notion that the Fed might cut by another 50 basis points. They did with their first cut by 50 basis points, but now markets expect November and December cuts to be 25 basis points. Market seems pretty relaxed about that. Overnight, the S&P closed within 1% of an all-time record. The chances of the US going into recession anytime soon seem remote. And so it's almost a Goldilocks scenario. That's for the US. We'll come back to that in a second. The other things to talk about are the stimulus announcements in China, whether that's sustainable or not, the effect on commodity prices, the effect on the Australian dollar, and what's happening in the Australian economy. But let's start with the US. John, what have you made out of the more recent economic data out of the US, which seems very, very strong, very stable?
Yeah, well, the labour numbers were a surprise. I just looked at the forward yield curve. It looks like the expectation is that interest rates will track down to 4% on average over the next 2 years, and they're currently at 5%. So that's probably a pretty good indication of this, that interest rates are going to come down, but a lot slower. I think we have to also acknowledge that there's some pretty big cyclones going through America, and the rebuild. I mean, we had a bad one 2 weeks ago, and now we've got a huge one going through in the next few days. And every time this happens, there's a massive rebuild required. So that's government expenditure and that's stimulation. So that adds to economic activity. So that's probably in the background, which may be coming to the foreground shortly. And as you said, there's stimulation packages coming from China. The US dollar bounced back in the last few days, a bit of a surprise. We were saying you could see the Aussie dollar trekking up and it just got smacked in the last week, down 2%. But I think it'll recover and start moving up again, just on the basis that the Chinese stimulation, you can say it's underwhelming on fiscal, quite strong on monetary, but commodity prices have jumped, which should support the Aussie dollars going back up again, I would have thought.
Yeah. You mentioned the hurricane activity. There's a huge Hurricane Milton, which is about to hit Florida, and that's obviously pushing up oil prices because of potential disruption. The other factor pushing up oil prices, of course, is the war in the Middle East and the chance that Israel may hit Iranian oil refineries. Now, whether that happens or not, it's something that we do have to be aware of that could be a bit of a spark to the oil price.
Well, it's interesting, Paul. I mean, we've got to remember who's buying the oil off Iran. It's China in the main. Russia's selling its oil to India and China. China's remarkably quiet on the world stage at present as this Middle East conflict unfolds, so they're just keeping numb on the whole thing. Biden last week stirred up oil prices when he said he said there could be an effect. There could be a targeting of oil in Iran. I mean, that was a bit strange, but he did warn against it because it would send oil prices up and reignite inflation. And it had. When he said it, oil prices rallied, so it was probably not a sensible thing to say at the time. The world is on edge. We've got inflation coming down, and it's tracking and following oil. So, I think there is an world economic imperative to keep oil prices around the $70 mark and not go back above 80, and also the recovery in China. And China's, they're on top of inflation. It wouldn't be good news for them either. So it'll be interesting to watch what is said by the Chinese administration, if it says anything about what's going on in Iran, and what actually happens, of course.
Yeah, John, let's bring it back to Australia. So something like 40 central banks across the world have lowered interest rates. The RBA, of course, is saying that it's data dependent and not in any rush, and going to be very cautious about it. Do you still think that there's a chance that the slowing Australian economy means that there could be a cut in Australia before the end of the year, or do you think February is more likely now?
Well, I don't want to sound like an economist and say there's 50% chance it could happen before Christmas and 50% after Christmas. That's essentially, I mean, Australia's in a bind, and we know this. Interest rates weren't pushed up aggressively because of the excessive debt in the mortgage sector. From a political positioning, interest rates which affect the household sector are much more significant on the electorate than obviously interest rates which affect the bond market, as the case in America. So, we didn't go up fast enough. I think the Reserve Bank is trying, even though it's not saying that, to try and get the Aussie dollar to go up prior to cutting interest rates, because the deflationary effects of the Aussie dollar going up would offset, the effect of the interest rates coming down if there is a view that would stimulate some sort of demand issue in the economy. I don't think it's that significant. But yes, you're right. The rest of the world has cut interest rates, and we've got a New Zealand decision in the next day or so, and they'll probably cut by another 0.5%. But their aggressiveness sent their economy into recession. So
yeah.
The Australian Central Bank didn't send the Australian economy into recession in terms of economic growth, but we actually have a recession in terms of per capita income. That's our recession, and that's what they're dealing with.
John, we're in the last couple of months of the year. There's a run up to Christmas. Christmas sales are so important for the retail sector, and I know you're connected with small business in one way or another. And I did notice a little bump in Australian consumer confidence. I mean, it's coming off a low base, but it seems to have turned upwards. What sort of kind of anecdotal information are you getting from small business about the prospects for a reasonable Christmas in Australia?
Look, it's not exciting. There is that steady growth happening after we've brought in a lot of people through immigration, and we continue to do so. We still haven't got a proper tracking from the government of how many people are coming in. But the latest statistics I saw, again, it was a large number. So that filters through the economy. We've seen a slowing of the economy. We're off the bottom, so to speak, as the effects of these people come through. I think there's a little bit more confidence because the press is running with this idea that the central bank may cut before Christmas. And the release of the statement or the discussion by the Reserve Bank and their output statement said, left the interest rates going up off the table. So I think we're over that nonsense, because that was destabilising the consumer. The threat of higher interest rates I thought was an idle threat, should not have been made, and that was having an undesirous effect on consumers. That's off the table. The press are running with there may be an interest rate cut before Christmas, and that just is helping stimulate a little bit of activity. But you're right, Christmas is going to be crucial, absolutely crucial.
And looking at where markets are at the moment, so the ASX somewhere between 18.5 and 19 times forward earnings. In the US, of course, the market's even more expensive, up at about 22 times. Should investors be fully invested at this stage on the basis that there's a recovery in 25, or should investors be cautious and keep some of their powder dry for when a turnaround is more entrenched?
Well, I think the world economy is fine. That the IMFs have come out, and I think world growth forecast is around 3.25%.
Yeah.
Chinese forecast growth, I mean, China's targeting 5. The IMF's saying they'll be more likely to get 4.5, and for some reason they think that's a recession. When you get 4.5% growth, I just look at that and say that's quite a bizarre view. America's economy, as we just said earlier, is growing nicely with employment numbers. The world growth is there. Valuations are, very full. We've had a correction in the bond market recently. I think we should alert everyone to that. The American 10-year bond went back above 4% after touching 3.6. The Aussie bond's about 4.25. Normally that would pull back the equity market, and it hasn't done so. Australian share market stalling a bit as there was a bit of rotation. Yeah. American market continues to rally on the back of the big stocks, Nvidia in particular. My view would be I think we're due for a bit of a correction in the market. Won't be severe, but I think history tells you buy those corrections. So if we get a 2 to 5% correction in the stock market, no one should be surprised. And that'd be a good time to pick up stock. Whether you should be fully invested. You should be fully invested across asset classes, not so much fully invested in the equity market. I think that's the view. And with full valuations everywhere, you just, you have a nice spread of assets.
And one of the things that we focused on in numerous conversations has been the need for income for retirees. Yeah. Spoken a bit about that, the rule changes with hybrids and that market diminishing. Still reasonable yields available from some of the REITs, utilities, and so on. Is that?
Yeah. Yeah, I think you're right. I mean, it's not a mad rush, but if we do get a slight pullback in the equity market, it'll probably throw up a bit of yield across the market. So you'd be active there. Just another comment, that the banks reported yesterday they are beginning to adjust their mortgage rates for new home buyers, and so they're jumping ahead of the Reserve Bank. So that sort of outlook, gives you reasonable confidence for next year in the equity market. Those tailwinds will push the equity market higher, even though it doesn't look particularly cheap. It sustains. That's sustaining tailwinds. So our confidence is maintained. Just looking for a pullback to give us an opportunity to buy some, the stocks we want to buy.
Yeah. So the message seems to be that don't be too swayed by the daily volatility and the news story of the day, and a long-term sensible strategy remains the best path forward.
And look, right now, the market in Australia is bereft of any information. We've had our reporting season. Yeah, we go into some conferences in the next month or so, I think, and then we get the AGM season where there'll be updates. That'll be the next bit of information. Other than that, it's just hedge funds, pair trading, and there might be a bit of corporate activity, M&A, rumours. But really, we're just going to bounce around going nowhere for a little while. So we've just got to keep our eyes out on if something is pulled back too aggressively because the hedge funds are active. I mean, that's the way of the world today. Unfortunately, it's just, contrived volatility to try and make something happen when there's not much happening.
Yeah. Look, I think that's a good enough summary. We can end it there. And anything you want to add, John, before we turn it off?
Oh, look, we had a quick chat before. I think, we shouldn't make predictions, but I think the American election is heading towards the Republicans. I think that's we often talk about, is that good or bad for the markets? I don't think it makes any difference. It may, throw up some international issues in terms of what America may do on the world stage. So I think it's becoming increasingly likely that that's what's going to happen. It'll be a tight election, but I think it's interesting. I think the polls are suggesting Trump is now, edging up, and I think the betting markets are saying that, and the betting markets are probably your best call.
Yeah. All right. Well, we'll end it there. It's all very interesting, and we'll see what unfolds. Thanks, John. Good to speak to you, and to everyone out there. We will see you next week. Thank you.
Yeah.